Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on. Market's obviously turbulent today. S&P 500 right at about 5370 as I'm speaking. That's down about 1.5% on the day, down about 2%, a little north of that for the week. We did have a little bit of a spike up in the middle of the week, and now you're seeing some headlines about a big 2-day slog downward. I just remind everybody that we're only about 2% where we started off of where we start the week. And all of that is really being driven by a jobs report that came out yesterday, which is a lot weaker than people were expecting. So previously, unemployment rate had been at about 4.1%. That number jumped up to about 4.3%. We had been looking for about 175,000 new jobs added. We got about 114,000 new jobs added. So obviously some weakness there. And I would just remind everybody that there are two sides to the sort of soft landing coin that we've been talking about for a very long time now. On the one hand, back in April and May, we were talking about the side of the coin, which is, has the Fed done enough to kill off inflation? These price increases continue to kind of run away, and maybe we need to do even more. Maybe we need to keep interest rates higher for longer or raise them even higher than what the Fed has originally done. The other side of that soft landing coin is, have we done too much? Seeing that weakness in the labor market, really is starting to make people worry that maybe the Fed has done a little too much to kill off inflation, and brings up that fear of the economy slowing materially or maybe even entering some type of recession. And that's the reason why you're seeing the market sell off a little bit today. I would just note in that regard, this is the same reason why bonds are actually doing quite well today. So the Barclays Ag up about 1.5% for the week, which is doing exactly what we intend it to do in a balanced portfolio. As people start to get scared about an economic slowdown, they run to bonds, and bonds generally outperform, and it gives you that nice inverse correlation within a balanced portfolio construction that we're looking for. So in that regard, the portfolios on the balance side are performing exactly the way that we would expect. Equities down, bonds up, they help offset one another. In terms of the good news that is out there, I would just note that the Fed is aware of what is going on. So earlier this week, they put out a Fed statement in which they moved what they're sort of focused on or what they're worried about in the economy. Previously, in prior Fed statements, they had said they were worried about inflation. In this most recent one, they said we're worried about inflation and jobs, kind of a balanced approach. So they're aware of what's going on in the labor market. And I do think that their next meeting is in September. It is widely expected that they will cut rates. If we get a weaker than anticipated jobs report in the August report, I would expect them to cut even more aggressively than maybe the market's looking for. Right now, the market looking for about a 1/4 point rate cut in September. I think if the jobs number gets weaker, you could see even up to 0.5% to try and let the Fed get back out in front of what the trend is. I would also be remiss if I didn't note that it is earnings season. We've had about 370 companies in the S&P 500 reports. Those earnings actually coming in quite well. Revenues up 5% year over year, earnings up about 11% year over year, kind of in line with expectations. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.